It's a disappointing start to earnings season. IT major TCS misses muted estimates dollar revenue growth for off the mark for the 6th straight quarter, but margins remain stable and profits are in line.
A double whammy for the economy. Industrial production contracts over 3% as manufacturing growth plummets. Inflation accelerates at 5.6% due to sharp spike in food prices.
Bulls flee Dalal Street as the markets hit their 52-week lows. The Nifty clings on to 7,500 only to end at its lowest level in 18 months.
Oil prices stabilize after hitting fresh multi-year lows, but oversupply shows no sign of easing as analysts further trim their forecasts.
There's no other developing country in history that has taken on debt as rapidly as China has done since the 2008 global financial crisis. And I think that's really what's happening now, that it's paying a price.
China may spark a mild global recession, says Morgan Stanley's RUCHIR. SHARMA predicts oil prices unlikely to fall below $30 a barrel.
Bankers meet the finance minister as the budget countdown draws closer and closer. Ask for an increase in income tax exemptions to boost consumption. Also propose to ramp up public spending with an eye on the fisc.
Tamil Nadu's bull taming festival will have to wait. The Supreme Court imposes a stay on the centre's notification allowing the yearly ritual.
The FIFA Ballon d'Or 2015 goes to Lionel Messi.
Ladies and gentlemen, the winner of the FIFA Ballon d'Or, congratulations to Lionel Messi. What a spectacular year he's had. Congratulations, Lionel.
Well, after 2 years, the Golden Ball is back with Lionel Messi. He's pipped Ronaldo as the best footballer on the planet. Good evening. Thanks very much for joining us on India Business Hour. Hi, Nandara.
Hi, Sheila. I'd like to point out he's won that for the 5th straight time.
All right, for the 5th straight time. That's not what we can say about the markets, though. There's no winning streak for our markets. In fact, the torrid start of 2016 has just gotten worse. The market slumping once again, in fact, hitting their 52-week lows in intraday trade. The Nifty managing to cling on to 7,500, but ended the day at its lowest level since July of 2014. Let's bring up the Sensex. That lost nearly 150 points, once again closing at its lowest level in 20 months. Banks taking it on the chin today, with the banking index losing nearly 2%. But a quick check on the action on Wall Street, because global cues, at least for now, are looking positive. The Dow, the S&P 500 and the Nasdaq are all trading with strong gains. They've come off their intraday highs, but still higher by about 1% for the Nasdaq. The Dow has put on about 0.5%. Similar picture across Europe. All the major indices have ended the day with healthy gains. So the European markets ending the day fairly strong, with gains of over 2% for the DAX and the CAC. But what about crude, Nandara?
Crude against crude also, Shireen, we have a green tick. We saw oil prices stabilizing after hitting fresh 12-year lows today. In fact, they're back in the red now. So Brent at just about $31, and same for the NYMEXD. At one point, it sunk over 3% and was headed towards a $30 mark. Crude prices in 2016 have crashed by 20%, and in the last 6 sessions have crashed by 15%. Brokerages like Barclays, Macquarie's, Bank of America, Merrill Lynch and Standard Chartered have all weighed in the price rush and further cut their forecast for the year. And with crude prices hitting multi-year lows, oil giant BP today announced it's going to be laying off 4,000 employees across various geographies, including America, Afghanistan, in the E&P business. Last year also we had seen BP cut 4,000 jobs.
Well, crude prices now declining again, 31.44 and 31.17 for NYMEX. But the top story this evening, the third quarter earnings season is kicked off On a disappointing note, IT major TCS has missed expectations once again as the Chennai floods have taken their toll on the company. Now, before we bring you the analysis, let's take a look at the key positives and the negative. Number one, dollar revenue has missed the mark for the 6th straight quarter, contracting by about 0.3% sequentially. So that continues to be a concern. But profits are in line. Margins have fallen but remained largely stable. Number two, the India business, and this is the worry here, has disappointed with an 8% contraction. But on the positive side, the company has added 34 new 100 million clients. Rima and Kritika standing by now with their analysis. Rima, to you first. It's been 18 months and TCS continues to be behind market expectations. What seems to be going wrong?
TCS has missed street expectations for the 6th straight quarter now. The dollar revenues have gone down by -0.25% versus analyst projections of 0.7% growth, which means a miss of close to about 1% compared to street expectations. The culprit seems to be India because the international constant currency growth is 1.1%, but there has been a negative impact of close to about 60 basis points due to India, which has dragged the overall constant currency growth to 0.5%, and volume growth this quarter seems to be at 40 basis points. Margins have come in at 26.5% in line with street expectations. It's come down QOQ, largely on account of the SG&A and only partly offset because of the rupee depreciation. Profits at 6,100 crore are up 1%, and that is slightly better than street expectations. Digital has gone up by 4% QOQ, but the growth is less than the 10% that it saw in the prior quarter. Client addition has been fairly steady this quarter, and the positive, however, is that the attrition has trended down after 7 successive quarters of an increase. In terms of the key geographies, North America steady 1.25%, Latin America bounced back, India is weak. BFSI has also been has seen some contraction on account of Diligenta, and consulting has done very well for the company with a double-digit gain. Net, a muted quarter, and the stock perhaps could be a bit subdued tomorrow.
And Kritika, now coming to you, you were there at the press conference. What was the commentary from the management? Give us key highlights.
Well, over and above the impact of the Chennai floods on overall performance and the seasonal furloughs, India has hit the overall top line and the constant currency growth by almost 50 basis points. And while that will not continue in the next quarter, it could see quarterly fluctuations. Now, the other areas that are a bit of a worry point for TCS are largely Diligenta, which will continue for another quarter in terms of softness. And Latin America, while it has performed well this quarter, some amount of headwinds over there as well, including Japan. Now, going forward, volume has come in up by about 0.4%. That is worrying, but the margin should be maintained within 26 to 28%. Attrition has come down to 15.9%, and there is a further uptick for that, but utilization at 84% is expected to be maintained. More importantly, IT budgets. While there hasn't been any major negative swings expected, the management seems to be slightly cautious to an extent. They're waiting and watching to see how IT budgets pan out. But overall, investors can take heart from the fact that Q4 will be better than Q3, and the fact that they're running on almost a $2 billion quarterly annualized revenue run rate for digital is definitely an impressive performance from the digital perspective.
Fundamentally, I've always maintained that till the jobs growth happens in all markets, you should factor in protectionist tendencies in different markets. And the visa fee hike is more a cost issue than a revenue issue. I wouldn't overly raise a big concern on that, because on our size and scale, yes, we don't like it. It adds cost, and also it's something that's very one-off. Okay, one-off from the point of view of only certain companies are affected. But I wouldn't talk that it's a very, very big issue. Our gross margins have expanded by about 20 basis points. We have lost primarily in the SG&A side, which is contributed from all of these factors. The furloughs contribute to that. You would have seen our utilization has gone down. The impact of the Chennai floods, quite a lot of that cost also is sitting out there. Not much to break out. It's about 70 bips down on that. And exchange has contributed to a positive about 15 basis points. So totally about 50 bips down on that. So in terms of long-term outlook on margin, there is no current immediate threat to that margin band. We continue to project that. And as and when things change on that, we will call that out. But as of now, we are fairly comfortable staying with that 26 to 28 band.
Well, that's the TCS management, and you can catch more of them right here starting tomorrow morning on CNBC TV 18. Now, weak earnings could add more pressure on the economy, which is showing signs of a slowdown. Industrial output in November has contracted by 3.2%. Manufacturing growth has plummeted. Not just that, retail inflation has inched up in December, and it stands at 5.6%. Latha joins us now to make sense of those numbers. Latha, let's start with Iip. It is clearly a shocker. Base effect, Diwali, so on and so forth. Discounting all of that, what should we make of this number?
Well, you will have to take the number for what it is telling you, and it is telling you that it is a rather bad number. Coming in at minus 3.2% and manufacturing minus 4.4%, and electricity, we've had double-digit growth for a better part of 2014 and early 2015. It dropped to single digits, and now it's not even 1%, 0.7%. Capital goods, I can understand, it's a lumpy number. We saw 16% last month and near double digits even the month before. So one was prepared for a contraction, but even a contraction of 25% is a huge one. It's consumer durables and non-durables that are really the bad number, and among them consumer non-durables, the fast-moving goods, that's coming in once again in negative terrain at minus 4.7. We briefly saw it improving in the previous month, that is in October, but once again November contraction for April to November as well. Consumer non-durables, which is really fast-moving goods, have come in at minus 0.5. So you can see that consumption definitely rural area consumption is not picking up. Even some of the infrastructure sector, like electricity, has shown some debilitating weakness. This doesn't look like a passing weakness. Capital goods one can take in your stride, but the rest of it is seminal weakness. Just a word on inflation. The numbers come in slightly higher than our poll of 5.5% and higher than last month as well. The worrying number is food, coming in at 6.4%, but there is a base effect. Inflation will still come below the Reserve Bank's original number of 5.8 for January. It will come lower than that, but it is still a little bit of a niggling worry that core inflation is a little high. That, according to some analysts, it's a derived number, is at 5.7. Now, if that is the sustained inflation, 5.7, when you strip off the volatile elements like food and fuel, and that's not a very comfortable number. People are at the most expecting one more rate cut, and even that will depend on the quality of the fiscal deficit.
So let's go across now and speak with the Chief Economic Advisor, ARVIND Subramanian. He joins us now to discuss the Iip data as well as the inflation print. Mr. Subramanian, appreciate you joining us here on CNBC TV 18. Growth concerns back front and center on the back of the contraction that we've seen as far as the Iip data is concerned. Even if you factor in the fact that it was Diwali that we can account for, and that could have led to some degree of what we're seeing show up in the Iip, but even factoring that in, it is a weak number.
Well, I think it has been affected by at least two one-off factors, right? One is what you mentioned, the Diwali, and the other, of course, is the Chennai flood. So one has to be careful about interpreting both the November number and the October number as well. So I think that the number that one should focus on perhaps is that, April to November, it's still substantially higher than last year. But there is mixed news there. For example, while consumer durables did well, capital goods actually saw a big decline. So, in a sense, it's consistent with the message we had in the mid-year that the economy, while probably trending up, is showing mixed signals. Consumer sector is doing well. Capital goods and investment less well. So this is kind of consistent with that pattern.
It is consistent with the message that the mid-year economic review held out, and you had very clearly articulated there that the indicators that we are seeing suggest that the recovery in the economy is mixed at this point in time. But does this give you concerns now about what we could expect as far as the manufacturing rebound is concerned, or the possibility of the rebound in the manufacturing sector? Because it does seem to suggest a loss of momentum there.
Well, actually, even if you look at the manufacturing number, April, November, is actually higher than last year. So, the trend is up. How robust that will be remains to be seen. But I think that also remember that the December indirect tax revenue numbers were also quite robust. Even without the revenue measures, the new measures, revenue growth was about 10.5%. So, so again, it's some good, some less good, but broadly very consistent with the mid-year, and nothing to suggest that it's collapsing or gone down significantly or whatever. So it's kind of as we painted it in the mid-year economic analysis.
In the mid-year economic review, you were forced to scale down the government's own growth projections down to 7.5% from the earlier projection of 8 to 8.5%, which was the budget estimate. On the back of the data that we're now getting, do you believe that we could perhaps see a further downward revision?
Well, you see, the estimate in the mid-year analysis was between 7 and 7.5, and I don't think these numbers are going to change that projection or that forecast that we have. We'll have to wait for the third quarter GDP number to come in, which will be around, which will be at the end of January, and then we'll get a better picture for what the number for the year as a whole is going to be.
How concerned would you be about the CPI inflation, which has picked up to about 5.6% year-on-year, largely on account of food inflation?
Yeah, I think there too, you can see that, core inflation is at about 4.5, 4.6, 4.7 in that range. It's been trading in that range. And again, the big jump in pulses prices as well accounted for a big part of the increase in the food price and in the CPI as well. Remember that with prices, there is some good news in the months ahead as well, that because oil prices have come down even further, and that will be reflected in the inflation numbers in the months ahead. So there is some, looking ahead, some likely good news also on CPI. So, again, broadly coming down in line with our expectation and with the RBI's target. Some further good news down the road because of the oil price. So, so on the whole, not too bad.
So you believe that the momentum of core CPI continues to remain soft. Do you believe that there is still room then for at least another rate cut by the Reserve Bank of India, whether it happens in the April policy or not? The timing is a separate matter, but do you believe that there is still room for at least another rate cut by the Reserve Bank?
Well, let's see how the inflation evolves going forward. I mean, all this will be data driven, of course, as the RBI has made clear. And if the oil price effect works through, maybe there's room, but there are also other factors which have to be kept in mind. So let's wait and watch.
A quick word on the sort of rural distress that we're seeing and how that's likely to continue to weigh on growth. I understand that a new crop insurance scheme is going to be taken up by Cabinet. I don't expect you to take us through the details of that, but what is the sense that you're getting on account of the rural distress and the kind of impact it will continue to have as far as growth is concerned?
Yeah, I mean, I think this year, the fourth successive drought, Rabi plantings are down, moisture levels are down, temperatures are up. So that will invariably affect agricultural GDP growth and rural demand. So I think that we've kind of factored that into account. But I think in terms of, the government is committed to responding to that with, with all the resources that it can. And so, as I've said before, agriculture is going to be a big part of the discussions leading up to the budget as well. So the government is fully aware of the stress in the farm sector from all that's happening, and is committed to really increasing the resources devoted to this sector.
But on balance, ARVIND Subramanian, you put out a fairly mixed picture in the mid-year economic review. Do you feel more concerned about the headwinds, whether it's fiscal or otherwise? The external challenges, of course, also continue to look extremely gloomy with what's happening in China today. The global markets continue to be extremely volatile. Have the headwinds gone up since you presented the economic review?
Well, I mean, not significantly. We're all watching what China is doing. I think that's something we have to watch, and we'll have to respond appropriately. So for the moment, I think broadly the messages in the media stand. Always have to be vigilant to everything that evolves in the external environment.
ARVIND SUBRAMANIAN, we'll have to leave it there. The Chief Economic Advisor speaking exclusively to CNBC TV 18. Now, North Block is where all the action is. Today, we saw the process of budget consultations continue. It was the turn of bankers to meet ARUN JAITLEY. So whether it was the top boss of the country's largest public sector lender, Arundhati Bhattacharya, or HDFC Bank's Managing Director, ADITYA PURI, they were all in attendance, and they want a better balance between public spending and fiscal prudence. On the tax front, bankers have urged the government to increase the income tax exemption in a bid to boost retail spending.
Key issues were how to address growth and how to address the fact that given the reduction in nominal GDP, there is a reduction in tax collection, and so there is an imperative as well. Everybody was of the consensus that public expenditure is necessary, and if that's necessary, a balance will have to be done between fiscal deficit and the expenditure, and maybe it has to be delayed. These were only suggestions, and certain tax suggestions as well as the other policies that the government has put in should be moving us in the right direction.
There is still very sticky consumer inflation in the economy, and but it was well within Reserve Bank of India's target of 6%, and the target was for January 2016. So I think there is some good news in the bad news.
Do you expect this trend to continue in terms of?
No, unlikely. I think very unlikely, because once the base effect comes into play with overall price mitigation, food price are largely under control, including cereal and edible oil prices. I actually see a downward trend in CPI, and therefore a very strong case for interest rate repo reduction in the first half of this fiscal year.
So the wish list of the bankers. The finance minister also met with representatives of the social sector today in order to get a sense of their demands. Social sector groups today demanded doubling of allocation towards the health sector and a higher rate of sin tax on tobacco as well as alcohol. Not just that, representatives from the social sector sought allocation under the Mahatma Gandhi National Rural Employment Guarantee Act to be increased by 5,000 crore rupees and a spend of 10% of the GDP on the education sector.
Well, here's the big CNBC TV 18 exclusive tonight. Morgan Stanley's SHARMA has warned of a bumpy ride for the world economy in 2016. Here are the key highlights of RUCHIR's interview to CNBC. Number one, China is the biggest risk facing the world right now, and China is paying the price for massive debt accumulation and could in fact cause a mild global recession. Now, if this happens, this will be the first China-led global recession. Remember, so far all the recessions have been led by the United States. RUCHIR also expects growth in the US to be around 1.5% in 2016. That's due to the slowdown in China, so it's lower than what is the forecast. And finally, he believes that oil prices are close to the bottom and are unlikely to fall below $30 a barrel. It looked like it was in danger of doing exactly that, but we've edged up a little bit since then. He also believes that oil prices will be peaked at around $70 to $80 in the near future, as and when the rebound does indeed take place. Here's RUCHIR Sharma in a CNBC exclusive.
What's been happening in China has really been taking place over the last few years, which is that there's been a massive build-up in debt. In fact, there's no other developing country in history that has taken on debt as rapidly as China has done since the 2008 global financial crisis. And I think that's really what's happening now, that it's paying a price for this massive accumulation in debt. Now, when exactly this will lead to a meltdown is very hard to call, but this is the big risk that the global economy faces currently.
I wonder what that also means, because it's an unusual situation. The U.S. declining and sending the global economy into recession. We've seen that. It's not pretty. What does this version of a downturn look like, and how does it come back and affect U.S.?
Well, first off, I think that the 2008 experience was extremely unique as far as global recession goes. There have been about 5 global recessions over the last 40 years or so, and 2008 was a very extreme version on that. So I think that is really off the table. That's not what I'm expecting. But it is quite possible to get a milder global recession this time based on what's happening in China, just because the Chinese economy has become so large and significant in the world today. All the global recessions in the past would be caused by the United States, but now China has become the largest contributor to global growth over the last decades. And regarding your question on how this impacts the US economy, well, I don't think the US economy needs to fear an outright recession. But I think that in the US, what we're looking for is that in 2016, we started off with most growth forecasts of around 2.5% growth in 2016. I suspect that those need to come down by possibly a percentage point, and we could grow in 2016 by 1.5% due to the weakness in global demand, which hurts US exports and also hurts the profits of US companies, which are increasingly exposed to foreign sales.
All right, so far we've seen this commodity prices moving lower as if we're in a recession already. Some interest rates around the world are negative now, suggesting recessionary times there. Does that continue, or are we hitting bottom right now, or what do you think the fallout is from the economic forecast you're making right now?
Well, the economic forecast really sort of suggests that if you look at the history of commodity prices, after having a boom for a decade, they spend a long time correcting the excesses of that decade. So the 200-year history of commodity prices is that in inflation-adjusted terms, commodity prices have gone nowhere. But after a very strong boom, they typically spend about 15 to 20 years in correcting the excesses. So I think that commodity prices from here may not fall much further, but what you can expect is an extended trading range. And for the price of oil, I think that about 5 years ago, we all thought that $70 to $80 was a floor for the price of oil. That's likely to be the cap for the price of oil in the next 5 to 10 years.
So what's your bottom price then?
Well, I think that we're not that far from the bottom. I doubt that we're going to get much below another 10-15% on the downside for oil. But there's always a possibility for an overshoot. But it's very hard to see as to how the price of oil can sustain much below $30 a barrel. So I think that from 30, we could possibly bounce back up to 40, 50, and then languish there for a long time to come.
$70 to $80 likely to be the new cap for crude oil prices, of course, over 5 years. Today we've seen Brent and NYMEX struggling to defend the $30 mark. Here's the top national story. Supreme Court has ruled that the bull taming sport of Jallikattu will not be held this Pongal season, just days after the centre gave a go-ahead to this age-old tradition.
For the second year in a row, Pongal will be celebrated without the traditional sport of Jallikattu. This after the Supreme Court stayed the central government's January 7th notification allowing the animal sport. Animal rights groups led by the Animal Welfare Board of India had challenged the BJP government's executive order.
जलीकट्टू पर आज सुप्रीम कोर्ट ने पूर्ण प्रतिबंध लगाते हुए जो नोटिफिकेशन MOEF ने जारी किया था 7 जनवरी को इसको अलाउ करते हुए उसके ऊपर रोक लगा दी है. This is not a sport, this is barbarism.
In Madurai, there is anger and disappointment following the Supreme Court's decision. Bull tamers took to the streets protesting the stay order. With just 3 days to go for Pongal, arrangements for Jallikattu were in full swing.
If we go ahead and conduct Jallikattu at home, can they stop us? This is Tamil Nadu's sport of valor. It is the pride of Tamil Nadu.
On the political front, Tamil Nadu Chief Minister Jaitley shot off a letter to Prime Minister Narendra Modi requesting the centre to promulgate an ordinance now to allow Jallikattu to be held. With Tamil Nadu going to polls in the next 3 months, critics have called the BJP's notification to allow Jallikattu an attempt to gain political credit. But the BJP says it was only respecting an age-old tradition and the sentiments of the people of Tamil Nadu.
The central government actually respected the sentiments of Tamil youth, but Supreme Court with law it has been blocked. We did it with good intention. Now the law has put a block. Let us see.
Animal rights activists say Jallikattu is inherently cruel to bulls and regulations remain largely only on paper. 17 people have been killed and more than 1,000 injured because of Jallikattu between the years 2010 and 2014. With Anna Isaac in Chennai, I'm Shreya Thondia.
So the SC stays Jallikattu and Tamil Nadu, and now Jayalalitha asking for an ordinance.